The silver market is sending two different signals at the same time, and the tension between them is becoming harder to ignore. On one side, paper prices have adjusted lower, reflecting financial positioning, macro expectations, and short-term liquidity dynamics. On the other, physical demand has remained resilient, even persistent, in ways that do not align neatly with the paper narrative. This divergence is not unprecedented, but its persistence is notable. Markets are accustomed to temporary gaps between financial pricing and physical behavior. What makes the current episode different is duration. The gap is not closing quickly, and the mechanisms that usually reconcile it appear slower to respond. Paper-silver markets are efficient by design. They process information rapidly, reflect changes in risk appetite, and respond almost instantly to shifts in monetary expectations or positioning. Physical silver markets operate under a different logic. They are governed by procurement cycles, supply constraints, and end-use demand that does not fluctuate with daily price movements. When these two layers diverge briefly, the system absorbs the difference without consequence. When they diverge for longer periods, assumptions begin to matter. The prevailing assumption embedded in much of the market is that paper prices lead and physical demand follows. Lower prices are expected to slow buying, loosen availability, and restore balance. That assumption is being tested. Physical flows have not adjusted in proportion to paper weakness, suggesting that price alone is no longer the dominant signal guiding behavior. This does not imply that one side is right and the other is wrong. It implies that the market is misreading what each signal represents. Paper prices reflect marginal transactions and financial positioning. Physical demand reflects necessity, continuity, and longer-term planning. When these signals conflict, the mistake is treating one as a complete representation of reality. For professionals and researchers, this is where analysis becomes useful. Divergences like this often precede structural adjustments, not because they force an outcome, but because they reveal misalignment in expectations. The market is comfortable as long as those expectations hold. When they don't, behavior changes. Importantly, this divergence is not being driven by speculative frenzy. It is being sustained by steady physical absorption and cautious financial repricing. That combination is subtle, but it matters. It suggests that different participants are responding to different constraints. If you focus on silver as a structural market rather than a trading instrument, this moment deserves attention. Consider subscribing if this type of analysis, focused on how markets interpret signals rather than react to headlines, aligns with how you prefer to follow commodities. The key question is not whether paper prices will rise or physical demand will fall. The key question is why the market continues to treat one signal as dominant when evidence suggests the system is more complex. To answer that, we need to examine how and why paper markets can adjust faster than physical reality, and what happens when that speed becomes a source of misinterpretation rather than clarity. Paper-silver markets are built for speed. They exist to translate expectations into prices efficiently, often before physical conditions have time to respond. Futures, options, and other derivatives allow participants to express views on macro trends, monetary policy, and risk appetite without engaging directly with the metal itself. This abstraction is not a flaw. It is what gives the market liquidity. However, abstraction also creates a gap. Paper markets can move independently of physical conditions for extended periods, particularly when the drivers are financial rather than operational. In such cases, price becomes a reflection of positioning rather than availability. Physical silver markets operate under different constraints. Demand is tied to manufacturing schedules, supply contracts, and inventory planning. These processes do not reset simply because price has moved. Buyers who require silver to maintain production or meet long-term commitments do not exit the market easily. Their demand is sticky. This stickiness is critical. It explains why physical demand can remain strong even as paper prices weaken. The market often interprets this as a lagging response. In reality, it may be a rational one. Physical buyers are responding to constraints that paper markets do not price directly. The assumption that lower prices will automatically ease physical tightness rests on the idea that demand is discretionary. In silver, much of it is not. Industrial use, technological applications, and strategic stockpiling are driven by necessity rather than opportunity. These drivers reduce the sensitivity of physical demand to short-term price changes. When paper markets reprice quickly, they often assume that physical behavior will follow. When it does not, the divergence widens. At first, this is dismissed as noise. Over time, it becomes a question. That question is whether price is signaling surplus or simply reflecting financial recalibration. Paper prices can fall without physical conditions improving. When that happens, the signal embedded in price becomes incomplete. Markets are comfortable with incomplete signals as long as they are temporary. The discomfort arises when incompleteness persists. Persistent divergence forces participants to decide which signal to trust. That decision influences behavior more than the price itself. This is where misreading begins. The market treats paper weakness as evidence that physical demand is overstated or that supply is sufficient. Meanwhile, physical participants continue to operate under constraints that price does not reflect. The result is a system where expectations diverge alongside signals. Importantly, this does not imply imminent correction. Divergences can persist for long periods, but they alter how risk is managed. Participants who rely exclusively on paper signals may underestimate physical tightness. Participants who rely exclusively on physical signals may underestimate financial headwinds. For professionals, the value lies in recognizing the divergence as information rather than anomaly. It reveals how different layers of the market respond to different pressures. It highlights the limits of using a single metric to describe a complex system. Understanding this helps explain why markets sometimes appear to move unexpectedly. The movement is unexpected only if one signal is treated as definitive. When multiple signals are considered, the move often appears less surprising. To understand how this divergence can influence outcomes beyond interpretation, we need to examine how markets behave once they begin to operate with conflicting signals, and why resolution is often delayed rather than immediate. When paper and physical signals diverge for extended periods, the market does not resolve the tension immediately. Instead, it adapts around it. This adaptation phase is where misinterpretation becomes most costly, because behavior changes before narratives do. Financial participants respond to divergence by adjusting exposure rather than challenging assumptions. If paper prices weaken while physical demand remains firm, the default interpretation is often that physical buyers will eventually step back. Risk is managed on that expectation. Positions are sized accordingly. Volatility is interpreted as transitory. Physical participants, however, are responding to a different set of constraints. Their concern is not price signaling, but continuity. They are focused on securing supply, maintaining production schedules, and managing inventory risk. For them, price weakness does not automatically translate into reduced demand. In some cases, it reinforces the need to act while availability appears manageable. This difference in response creates a quiet asymmetry. Paper markets assume flexibility, physical markets assume constraint. As long as both assumptions can coexist, the system functions. When they begin to conflict, the divergence stops being informational and starts becoming structural. This is where the market often misreads the signal. Observers focus on price as the dominant variable and treat physical behavior as lagging or inefficient. In reality, physical behavior may be reflecting constraints that price has not yet incorporated. The error lies in assuming that speed equals accuracy. Paper markets are fast because they abstract complexity. Physical markets are slower because they cannot. When abstraction moves too far ahead of reality, repricing can become detached from underlying conditions. That detachment does not cause immediate failure. It creates vulnerability. Vulnerability shows up as sensitivity. The market becomes more reactive to marginal developments. Small changes in inventory data, delivery preferences, or procurement behavior attract disproportionate attention. What would have been ignored in a more aligned system now carries weight. This heightened sensitivity is often mistaken for speculation. In fact, it is caution. Participants are trying to reconcile conflicting signals without clear guidance. They hedge more actively. They shorten horizons. They avoid commitments that rely too heavily on assumptions about availability or behavior. Importantly, this phase can persist without visible stress. Prices may consolidate, volatility may compress. From the outside, the market appears calm. Internally, it is operating with reduced tolerance for surprise. This is why divergences matter, even when they do not produce immediate outcomes. They change how the system absorbs information. They alter the thresholds at which behavior shifts. They make the market less forgiving of errors. In silver, this dynamic is amplified by the metal's hybrid nature. It cannot be treated purely as a financial asset or purely as an industrial input. When paper markets lean too heavily on financial logic, physical constraints reassert themselves indirectly. When physical markets dominate the narrative, financial conditions eventually respond. The divergence we are observing suggests that neither side has fully adjusted yet. Paper prices have moved, but physical behavior has not followed in the expected way. That does not mean one side is wrong. It means the system has not resolved which constraints matter more. Resolution, when it comes, is rarely announced. It emerges through behavior, through changes in participation, through shifts in how quickly the market reacts to new information. To understand how and when that resolution might begin to take shape, we need to look at how prolonged divergence influences confidence, and why confidence, more than price, ultimately determines how markets realign. When divergence persists long enough, it begins to influence confidence more than conviction. This is a subtle but important transition. Markets are no longer debating which signal is correct. They are adjusting to the fact that signals are no longer aligned. Confidence in markets is not about certainty, it is about trust in process. Participants are willing to take risk when they believe the system will behave as expected under stress. When paper and physical silver diverge, that trust becomes conditional. The market still functions, but it does so with more hesitation. This hesitation shows up first in how liquidity is offered. Market makers remain present, but depth becomes more selective. Quotes are provided, but with less willingness to absorb large imbalances. The market becomes more transactional and less absorptive. Trades clear, but with greater sensitivity to timing and size. At the same time, inventory assumptions begin to matter more. Participants pay closer attention to where metal is held, how quickly it can move, and under what conditions it is likely to be released. These considerations are rarely decisive on their own, but they influence behavior at the margin. Margins are where markets change. As confidence narrows, participants require more confirmation before acting. Signals that once would have been sufficient now need reinforcement. This slows adjustment, but it also concentrates reactions. When confirmation finally arrives, the response can be sharper because positioning has already become cautious. This dynamic helps explain why silver markets often appear quiet before repricing. The quiet is not stability, it is restraint. Participants are waiting, not disengaged. They are monitoring whether divergence resolves naturally or persists. Physical demand plays a central role here because it anchors behavior to necessity. As long as physical buyers continue to operate without responding to paper weakness, the assumption that price will resolve the divergence loses credibility. The market is forced to consider the possibility that price is lagging reality rather than leading it. This consideration does not require consensus. It only requires enough participants to adjust behavior. Once that happens, the market's reaction function changes. Price becomes more responsive to marginal physical signals. Inventory data carries more weight. Delivery preferences are scrutinized more closely. Importantly, this shift does not require dramatic outcomes. It can coexist with consolidation. Prices may remain range-bound even as confidence dynamics evolve. The absence of volatility does not imply the absence of change. For professionals and researchers, this is where interpretation matters most. The question is no longer whether divergence exists, it is how the market is managing it. Is it being absorbed through flexibility or deferred through assumption? In silver, prolonged divergence often indicates deferral rather than resolution. The system continues to function by leaning on abstraction. Over time, that reliance becomes harder to sustain without adjustment. Understanding this phase helps explain why markets sometimes seem to change character without an obvious catalyst. The The change has already occurred internally. What follows is recognition. To complete the analysis, we need to examine how this internal shift eventually becomes visible, and why the transition from conditional confidence to explicit repricing often happens faster than expected once it begins. The final stage of divergence is not resolution through price, but resolution through acceptance. Markets eventually stop treating the disconnect between paper and physical silver as temporary friction and begin treating it as a condition that must be managed. This is where the misreading becomes most consequential. Once participants accept that paper prices and physical behavior are no longer tightly coupled, the market's internal logic shifts. Price is no longer assumed to be a complete signal. It becomes one input among several. Availability, timing, and confidence begin to matter more than headline levels. This change does not announce itself. It shows up in how participants behave under uncertainty. Risk is sized more conservatively. Exposure is managed dynamically rather than held with conviction. Liquidity providers become more selective about when and how they engage. The system remains orderly, but it operates with less tolerance for surprise. In silver, this matters because the market structure leaves little room for error. Supply is slow to respond. Much of it is byproduct-based and cannot be expanded quickly. Physical demand, particularly from industrial users, does not pause easily. When paper prices weaken without relieving those constraints, the divergence becomes embedded rather than episodic. At that point, the market is no longer debating which signal will prevail. It is adapting to the reality that both exist simultaneously. This adaptation has lasting effects. It alters how new information is interpreted. Inventory reports are no longer taken at face value. Delivery interest is watched more closely. Small physical flows carry more informational weight than before. The market becomes more sensitive not because it is unstable, but because it is operating closer to constraint. This is why repricing events often feel sudden in hindsight. The groundwork has been laid quietly through months of behavioral adjustment. When recognition finally surfaces, it appears abrupt only because the process that led to it was invisible to headline-driven analysis. For professionals, academics, and researchers, this is the central insight. Divergences between paper and physical markets are not errors to be corrected. They are signals about how systems are managing complexity. When those signals persist, they tell us that existing frameworks are being stretched. Silver's current divergence suggests that the market has been relying heavily on abstraction to maintain balance. That reliance is not infinite. It works until physical reality demands attention. This does not imply inevitability. Markets can operate under divergence for long periods, but when they do, they accumulate sensitivity. They become less forgiving of shocks. They reprice faster when assumptions are challenged. Understanding this helps avoid common mistakes. It prevents the search for dramatic endpoints. It shifts focus from prediction to interpretation. The question is not whether paper prices will rise or physical demand will fall. The question is how long the market can continue to treat one signal as dominant while the other refuses to conform. If this framework has helped clarify why the silver market's current signals matter beyond short-term moves, consider sharing it with others who approach markets through structure rather than sentiment. And if you have observed similar divergences in other commodities or asset classes, add your perspective in the comments. These patterns rarely remain isolated. The market is not confused, it is adapting. The misreading lies not in the signals themselves, but in the assumption that they must align immediately.